Hey there, folks. Tonight we're diving into the often confusing, always controversial world of international finance. Buckle up as we try to understand two major players, the International Monetary Fund, or IMF, and the World Bank. Think of them as the cool kids table in the global economic cafeteria, except instead of juice boxes and animal crackers, they're dealing with billions of dollars and the fate of entire nations. So, what exactly do these institutions do? In a nutshell, they lend money, but hold on, it's not as simple as your buddy spotting you $20 for pizza. The IMF and World Bank are like the wealthy relatives who bail you out of debt but then tell you how to spend your allowance. They provide loans and financial assistance to countries facing economic turmoil, but with strings attached. Critics argue that the conditions imposed on borrowing countries can be overly harsh, leading to cuts in essential services and increased poverty. So, are the IMF and World Bank benevolent saviors or neo-colonial overlords? Let's dig deeper, shall we? Alright, let's break down the inner workings of these financial behemoths. The IMF and World Bank are like two sides of the same coin, both working towards economic stability, but with slightly different approaches. Think of the IMF as the emergency room doctor of the global economy. When a country has a financial heart attack, the IMF swoops in with a quick injection of cash to stabilize the patient. The World Bank, on the other hand, is more like a long-term therapist, focusing on addressing the root causes of economic woes. They provide loans and grants for development projects such as infrastructure, education, and healthcare, with the goal of fostering sustainable economic growth. Both institutions operate on a system of weighted voting, where countries with more money get more say. This means that wealthy nations like the United States and European countries have a disproportionate influence on decision-making. The IMF and World Bank have provided crucial financial assistance to countries in need, preventing economic meltdowns and promoting development. Now let's talk about the developing world, where the IMF and World Bank have had a particularly significant impact. These institutions play a major role in shaping the economic policies of many developing countries, often with mixed results. Imagine a young, ambitious nation trying to find its footing in the global economy. They're eager to attract foreign investment, build infrastructure, and improve the lives of their citizens. Enter the IMF and World Bank, offering a lifeline of loans and grants. But here's the catch. These loans often come with conditions attached, known as structural adjustment programs or SAPs. The idea behind these policies is to create a more market-friendly environment, attract foreign investment, and promote economic growth. But critics argue that these measures often backfire, leading to increased poverty, inequality, and social unrest. Section 4. Success stories and cautionary tales examples of IMF and World Bank impact. So, how have these policies played out in the real world? Let's look at some examples. On the one hand, there have been some notable success stories. In the 1990s, South Korea used IMF loans to recover from the Asian financial crisis and implement economic reforms that helped transform it into the economic powerhouse it is today. Similarly, Chile's economic boom in the 1980s and 90s is often attributed in part to market-oriented reforms supported by the World Bank. However, for every success story, there are cautionary tales that highlight the potential downsides of IMF and World Bank intervention. The IMF's structural adjustment programs in the 1980s led to widespread austerity, privatization, and trade liberalization in Latin America. The lost decade of the 1980s in Latin America serves as a stark reminder of the potential human cost of poorly designed and implemented economic policies. Section 5. The Debt Trap. A critical look at the impact of structural adjustment. One of the most common criticisms of the IMF and World Bank is that their policies often lead to a debt trap. Imagine taking out a loan to pay off your credit card debt, only to find yourself deeper in debt because of high interest rates and fees. That's essentially what happens to many developing countries that borrow from the IMF and World Bank. They receive loans to address immediate economic crises or fund development projects, but the conditions attached to these loans can make it difficult to repay the debt. Austerity measures can stifle economic growth, privatization can lead to job losses and higher prices for essential services, and trade liberalization can make it harder for domestic industries to compete. As a result, countries often find themselves trapped in a cycle of borrowing, repayment, and further borrowing, diverting scarce resources away from essential services and into debt servicing. It's like putting a band-aid on a broken leg. It might stop the bleeding temporarily, but it won't fix the underlying problem.